Western CPE is keeping you in the know this tax season with our Federal and California Tax Update program. Whether you choose to attend a live update, a convenient webcast, or take a self-study course, we have the format that works for you. Join us now for news in real estate tax.
I'm Sharon Kreider, and I'm here visiting with Karen Brosi. Karen Brosi is an enrolled agent and a certified financial planner in Palo Alto, California. She has a tax practice that specializes in high-income individual and their tax planning issues. Karen has been in tax practice for more than 20 years. She's a California tax guru. She is a featured speaker for Western CPE's Federal and California Tax Update. In fact, Karen and I work together doing the Federal and California Tax Update. We're in 14 cities for 2 days each during November, December, January. We have breakfast, lunch, and dinner together. We talk tax all of the time.
Hey, hi, Sharon.
So let's talk about real estate. What's hot in real estate tax right now?
Well, you know, it's a great question because a lot of people think, you know, I haven't really seen any tax law changes in real estate recently. Is there anything that's hot in the tax horizon for real estate? And I think there are two very specific items that continue to be hot issues. And the first of those, unfortunately, is foreclosures and cancellation of debt income. Because we've not seen the last of the foreclosures, we continue to see many foreclosures. What we're seeing these days, I think, are foreclosures on investment property more than the personal residences, which kind of fell away from us in 2008 and 2009, and the trend is more on the investment properties, the commercial properties being lost to foreclosure. That's issue number one. Issue number two, I think that is the current issue that will pop for us as we enter into the season of filing 2011 and beyond returns, is a law change all the way back from 2008 that has to do with the exclusion on the gain on the sale of my principal residence. Because no longer can I simply say, if I meet all the 2-year rules, owned, occupied, haven't excluded gain on a principal residence in the last 2 years, no longer can I simply say, well, it's all excludable. Because if there was a period of time before it was my residence, that I rented it out, that it was a vacation home and not my principal residence, there may be some non-excludable taxable gain on the sale of that residence.
All right, so give me an example. Let's say that I had a rental house in San Jose, and I rented that house out for 10 years, and then I moved into the house for, let's call it 3 years.
Yes.
So I've owned it a total of 13 years. Under old law, it's been a while ago, but under old law, if I moved into that house for 2 out of the prior 5 years, which I did, then I could exclude up to a $500,000, $250,000 gain, $500,000 gain if it's a married filing joint tax return.
Correct.
How is that different now?
Well, the way that's different now is to the extent that I had not converted that dwelling unit to my principal residence before January 1st, 2009. That's why I say it becomes the 2011 and later issue. If I had not converted it to my principal residence by January 1st, 2009, that period of time after January 1st, 2009 that it was still a rental property is now something that's called non-qualified use. And for however long that went on after January 1, 2009, up to the moment that I moved into it, as an example, let's say you actually converted it to your residence in June of 2009. So as a result, you had 1/2 of a year of non-qualified use over the, now you're telling me, 13 years that you've completely used it. That 1/2, that ratio of 1/2 over 13 total years owned, I apply that to the gain. When you sell that property right now today, that is the amount of your gain that you cannot use the Section 121 gain exclusion on. You will recognize that as taxable capital gain.
And what about the depreciation?
Now, the depreciation rules haven't changed at all in that regard. Even under old rules, 13-year property, 10 years as rental, 3 years as your personal residence. When you sold that personal residence, we still had to go back and look at your Section 1250 depreciation from post May 6, 1997 and later. And that amount of the gain that was due to that depreciation was always going to be taxed to you anyway and not excludable under Section 121. So that part of it hasn't changed with regard to the depreciation.
So what has changed is that I can no longer move into my rental or move into my vacation home and spend enough time to grab the whole $500,000, $250,000, $500,000 exclusion. That's my real change right now. But wonder if, I've lived in this house for 10 years and I need to sell it. I do sell it. It has a very low basis in it because I've owned it such a long time. So I do have a gain on it and I want to sell that house. I can't sell it.
Right.
It just won't sell. So I rent it out for a year or two. So let's say I rent my house out for 2 years and then I finally get it sold. Do I have to make this allocation if I rent after I used it as a personal residence?
Well, and the answer to that is no, because this is law change dating back to July of 2008. It was in the housing bill in July of 2008. And at the time it was enacted, that was a special amendment that was placed into the bill to specifically exclude what it called the period of time after the property was your principal residence. That period of time is specifically excluded from the inclusion of or the calculation of your non-qualified use of the property. And it was, in fact, designed to help a taxpayer in exactly that circumstance, who it's always been their principal residence, or maybe it hasn't always been their principal residence, but it's certainly been qualified as their principal residence up to the point they want to sell, and because of the current market environments, they either won't sell or can't sell. And so they are forced to rent it out in order to maintain the property.
Now, I'm assuming there's a gain on the house.
Yes.
But I think there might not be a gain on the house. So I've owned this personal residence for just a few years. I bought it at the top of the market, and I paid $500,000 for it, and now it's worth $300,000. Can I deduct that loss, Karen?
Of course not, Sharon. And the reason you can't deduct it is the same reason why you can't deduct the loss on the sale or trade-in of your personal vehicle, which depreciated the moment you drove it off the lot as a new car. It's because it's considered under the law a personal loss, and personal losses are not deductible.
Could I convert that residence to a rental property and deduct the loss?
Well, you certainly can convert the residence to a rental property, but here's what happens. Then, for purposes of calculating the 1231 loss, which is what it would be for as a rental property that is sold, your cost basis for the 1231 loss will be measured as the lower of, the lesser of, your actual adjusted basis in the property or its fair market value at the time you converted it. So converting it and then selling it as a rental property gets you nothing because basis will be the same as fair market value.
Well, how come we all know that, but somehow it gets out in the press or in the, I don't know, the tweet, the Twitter stuff. Maybe the twits are twittering about losses, but we know it's the lower of fair market value or my basis in the house, and therefore the loss isn't deductible. We're talking about a declining market. That's really a little bit about where we are. Tell me what's new in foreclosures, or what I should know about in foreclosures.
I think it's what we should know about, that the foreclosures have not gone away. That's the first thing that we want to know about. We have literally struggled, all of us as tax preparers. We've seen them. We've been struggling with them as early as 2008. It's 2011. We want to say, aren't we done yet? Aren't we finished here? And the answer is, unfortunately, no, we're not. We worked through the markets of the 2008-2009 losses on personal residences that were foreclosed on. Now what we're seeing is, because the real estate markets are not substantially recovering, and in some cases, in certain pockets of the country still declining, we're seeing investors losing their rental properties, their commercial properties, their other kinds of investment real estate. It brings with it the loss. The foreclosures there now are bringing a whole new set of tax questions about how to handle those items. And so that's, I think, what's new in the area of foreclosures is it's a change of the kind of property that's being foreclosed on. And with that change, it brings a whole different set of facts for how to report. And specifically, what I mean with that is, first of all, client won't understand that that kind of foreclosure that results in cancellation of debt will almost always result in taxable income. There's not that safety net of it was my acquisition debt on my principal residence, therefore I can exclude the COD. That safety net doesn't exist. Worse, for the taxpayer investor who has lost that property to foreclosure that they originally acquired under a 1031 exchange, it has a very low cost basis. And that foreclosure is the same as a sale in the eyes of the tax law. And that's going to result maybe in cancellation of debt income with the double whammy of also recognizing taxable gain. Taxpayer won't understand. What do you mean I lost the property and I owe tax on the gain? Well, yes, you do, because you were able to defer paying tax on that gain at a point in the past when you did the 1031 exchange. So it's taxpayer misunderstanding about what the actual tax consequences are going to be from these investment properties. Second problem, this is an ongoing problem. This is not necessarily what's new. We've been seeing it all along, is, I know this will come as a surprise to you, 1099As and 1099Cs being issued are being issued incorrectly with incorrect numbers on them. Any old way the lender decides to report on them is what's showing up on them. So as tax practitioners, we're continuing to struggle with the proper reporting. When our taxpayer can assure us, can demonstrate for us, to show us that what's being reported as the actual debt forgiven on a 1099-C is not correct, that fair market value listed on a 1099-A on a foreclosure is not correct as of date of foreclosure. So we're having to struggle with what's the proper reporting, because those 1099s are coming out all over the place. And then the third and final issue ties to the fact that the trend is now it's investment property that I'm losing, is when it results in COD, I need to look at the whole range of Section 108 exclusions that might be available to that taxpayer, not just focusing on qualified acquisition debt from a principal residence, but looking more closely at insolvency and bankruptcy and certain debt on real property used in a trade or business.
Well, I think one of the two problems I've seen, the 1099-A problem of recourse versus non-recourse.
Absolutely.
That's a problem. We can get to that in a moment. But the other one, when you were talking about business property and deferring a gain, or the client had a very nice property, and as it went up in value, they borrowed money out of it to live on, to pay the payments with, to buy another property with. They took that money out, so they have also a basis that's lower than the fair market value of that property when it's foreclosed by the bank. So I think we've got problems in the business property that are not quite as apparent. But could you just give me a summary of the recourse versus non-recourse and how that's going to look for a cancellation of debt on my income tax return?
Absolutely. And the bottom line is recourse versus non-recourse. What the rules say is that if the debt is recourse, what that actually means is that the lender is first to look to the collateral for satisfaction of the debt. So how do they look to the collateral? They foreclose on the property. But if the fair market value of the property that they take back will not satisfy the outstanding debt, then under the recourse rules, they retain recourse to come after me for the remaining satisfaction of that debt. The result that's recourse. Let me start there. Non-recourse is, in fact, sort of just the opposite, sort of. What non-recourse says is that the lender is only allowed to look to the collateral for satisfaction of the debt. And if, upon foreclosure of taking back the collateral, that won't fully satisfy the debt, the lender has no recourse to come after me, the borrower, to satisfy the remainder of the outstanding debt. Now, that does produce two very specific differences in whether or not there will be COD as a result of that kind of foreclosure proceeding. Because under the non-recourse concept, when the lender has no recourse to come after me, they take my collateral. Yes, they write off the debt that may be in excess of the collateral, but because they never had recourse to come after me for that, I do not recognize cancellation of debt income in that regard. Opposite true with recourse. If they take my collateral and continue to pursue me for satisfaction of that debt, and at some point give up because they determine that I am the turnip and there is no blood in me, then that is forgiveness of that debt that they could continue to pursue me for, and that will result in cancellation of debt income.
Thank you.
You're welcome.
Thank you. We've been talking to Karen Brosi about hot real estate topics. Karen is an enrolled agent and certified financial planner in Palo Alto, California. She has 20 years of experience in tax, and you can certainly tell that real estate tax issues for her high income practice is part of that experience. And Karen teaches as one of the featured speakers of Western CPE's Federal and California Tax Update, the real estate section. So join us in one of those updates. We'd be happy to see you there. And you can hear a lot more about real estate tax issues and the computation of some of these complicated areas. Thank you.
That's Western CPE's Federal and California Tax Update, with 14 live locations throughout Northern and Southern California. If you can't travel, we offer convenient webcasts featuring our brand new 8-credit condensed version or the full 16-credit version. Webcasts offer you the viewing flexibility that works with your busy schedule. Your CPE, your way with Western CPE. Visit us online at westerncpe.com or call 800-822-4194.